I'm going to be going over the differences in the tax brackets in 2024, a little bit of the basics, insights into passive income versus ordinary income. But also the reason why a lot of you guys come to our channel is more for the sophisticated investors and how this plays in with withdrawing your retirement accounts and what's happening with your adjusted gross income. Let me just flash on the screen the 2023 tax brackets. What I notate on here is in the red dotted line, the big break between the 24 and the 32% tax bracket, which from the 10% to the 24% range, stepwise is pretty slowly. But once you get above 364,000 in 2023, things really go up. And this year, 2024, to no one's surprise, things just went up a little bit based off of inflation. So right now, that magic number is $383,900 for married filed jointly. So meaning that if your adjusted gross income is higher than that amount, you probably should really look around to some other alternative tax mitigation strategies. Now, some of our clients will do land conservation easements. Some will do oil and gas deals. I really recommend that a lot of people get into real estate investments so you can take advantage of using passive income, which you can offset with a lot of the deductions you get with real estate, thus lowering your adjusted gross income naturally. And for some of you guys who are using real estate professional status, which talk to your CPA. And of course, if you guys need a referral to a CPA who understands these more advanced strategies, some people are what they're doing able to drive their high income down to whatever they would like. Ideally, what we have most of our clients do is at least get under this $384,000 level, this red line, but maybe even drive it even lower than $200,000, getting them under that 22% tax bracket. So a little bit of the basics. The tax code works as a progressive tax system. So the first dollar you're going to make is going to get taxed at this 10% up to 11,600 for single filers and then 23,200 for married filed jointly. And then incrementally, the next dollar over the 23,200 is going to get taxed at 12%. It's just whatever is in that range. So you step up this range individually here. So all you guys should pretty much know that. I think we have more advanced listeners on this channel understanding that. Now, how does that tie into a lot of the moves that our more sophisticated accredited investors are doing? When we work with clients is they'll move money out of retirement, like 401ks, self-directed IRAs, maybe even their Roths, right? The whole idea, and I'm not going to get too much into it because we have so much other content on it that you can go to at thewealthelevator.com. And also check out our tax guide at thewealthelevator.com/tax. Is when you're locked into these retirement plans, you're getting some tax benefits there, but downside is you're stuck into these Wall Street types of investments, high fees, and you're not able to get the tax benefits that you would if you're investing through real estate. If you're investing in real estate, you're able to take the depreciation. And if you're investing in larger syndication deals, which we do, you're able to do cost segregations that drastically increase the amount of losses. Sometimes we see maybe 10, 20 times the amount of losses in that first year than you would have otherwise with just a regular rental property without a cost segregation and bonus depreciation. Sounds confusing. It was for me at one time, but a lot of this is automated by a good CPA. And your job out there is to invest in the things that give you these great tax benefits, such as real estate, but also to understand what I'm talking about here, to have that educated conversation with your CPA. So some people, what they'll do is, let's just say an example where somebody as a household, they're making about $200,000 adjusted gross income. So they're sitting here right in this 24% range. And that's great, right? Like they're not paying too much taxes. Of course, there can be something to be done to drive them even lower, but they have maybe couple million dollars in their 401ks. And to be able to invest in alternative investments and get better returns and tax benefits, they need to take that money out. They could also invest through a self-directed IRA. We're not huge fans of that for the most part. And it really gets into more your personal situation out there. So if you join our investor club, you guys get that free onboarding call. We can go into your own personal situation if a self-directed IRA or a solo 401k makes sense for your specific situation. But in most cases, what we see is people need to get their money out of the retirement 401ks. And even if it have to pay a 10% penalty, that 10% penalty is nothing when you compare it with the better returns. And usually the crossover point in recouping those 10% fees is pretty quick. but you're gonna have to pay the taxes on it and your adjusted gross income will go up. So again, for example, that guy making $200,000 a year as a family, say they take out $300,000 out of their retirement. So 300 plus 200 put them up in the $500,000 tax bracket category. So they're paying a lot of money on that higher end of that money, which may still make sense, right? If they can deploy that $300,000 into investments and make a higher yield there. This is where there is some strategy, and this is every situation is different based on where you are in this tax brackets. And we're teaching you the basics so you can strategize this on your own. But what some guys may do in this situation is take out maybe $183,000. So that guy's AGI would go from 200 to 383, and they would stay below this 32% tax bracket range. If you can get a sense of what's happening here, this is the strategy of leaking your retirement funds out slowly over maybe that guy would do that for the next 3 or 4 years. He's taking his money out and also he's doesn't have to deploy it all at the same time. That said, if he is implementing another strategy that we do, you can also check out more content on that on this channel. You can also go to thewealthelevator.com/bank. Somebody may opt to take out their entire retirement account and pay the big tax bill on it. Of course, there's other tax mitigation strategies that we have if somebody wanted to go with more of that aggressive amount. But as you can see, it's getting a little complicated. And this is where we say, well, build a relationship with us and walk through some of the older coaching calls that we have and maybe find your strategy and ingrain yourself in this alternative investment and alternative wealth building strategies that work for me. And I'm very passionate about because it changes lives, but you got to get educated about it. And you got to surround yourself with the right community. But that's the tax brackets here. One bonus tip, if you're able to do real estate professional status or drive your income very low, a lot of great things pop up for you. Like the long-term capital gains rates go way down. It's like a bonus multiplier when you are utilizing all these tax strategies to your benefit. And for the most part, when you get into real estate syndications or own your own rentals, you start to create what's called passive income, is what you want. You want to get away from what's on the left side here, which is ordinary income. Ordinary income is what you get through your 1099s and W-2. You want to get away from that because you're getting killed with all these taxes. The cool thing about passive income is that you're able to use these passive losses from real estate, and you can carry these over if you don't use it that particular year, but you can strategically use it to lower your passive income. And your passive income, in addition to your ordinary income, is used for these numbers on this slide here, which is your adjusted gross income. So for some of you guys who are starting out, don't have a huge portfolio, you probably have majority of ordinary income. Over time, once you invest more, the split between passive income to ordinary income gets higher. And if you can imagine the promised land where you have the majority of your income as passive income, and if you're able to use the real estate losses, the passive activity losses, or use 179 equipment deductions, which you guys can also Google out there, I just want you to get the wheels moving here. That's a way that you can really drive your adjusted gross income to zero, especially if you have all of your money as passive. And this is how you legally pay no taxes. And not saying that it's right or wrong. This is how the tax code is situated. So again, if you guys want to get more information about this, you can check out thewealthelevator.com/tax. And you get access to our massive e-course with all these types of tricks and tips. And if you guys need anything, feel free to reach out, team at thewealthelevator.com, and join our community at thewealthelevator.com/club.